Imagine waking up and seeing money deposited into your account. Not because you worked more hours, not because you traded something yesterday, but because you own businesses that are paying you for simply being a shareholder. That is dividend income. However, living off dividends is not about collecting random payouts from high-yield stocks. It is about building a structured portfolio that produces reliable cash flow without destroying your capital. Before thinking about freedom, we need to talk about reality. Dividend investing means owning shares of companies that distribute part of their profits to shareholders on a regular basis. These payments usually come quarterly, sometimes monthly, and they represent real business earnings, not speculation. When done correctly, dividend income can cover part or all of your living expenses. When done incorrectly, it can slowly erode your capital and create the illusion of income while wealth disappears underneath. The goal is to build sustainable income backed by durable businesses. The biggest modern mistake. Many people entering dividend investing today focus only on yield percentage. They see numbers like 8, 9, or even 12% and assume higher means better. In reality, extremely high yields often signal risk. They can indicate financial stress, declining revenue, unstable payout ratios, or companies borrowing money to maintain dividends. A healthy dividend strategy in today's market prioritizes balance sheet strength, consistent earnings, manageable payout ratios, and long-term business stability before yield. Quality first, yield second. How much capital you actually need. Let's move to numbers. If your goal is to receive $3,000 per month from dividends, that equals $36,000 per year. Now assume your portfolio produces an average dividend yield of 4%, which is realistic for a diversified, high-quality dividend strategy today. To generate $36,000 annually at 4%, you would need approximately $900,000 invested. That number surprises most people, but this is why planning matters. If you push for 6% yield instead, the required capital drops, but risk increases. If you accept 3% yield, capital requirements increase, but stability improves. Dividend living is a mathematical game, not a motivational one. Modern dividend investing works best when structured around 3 pillars. First, large, stable companies with global operations and strong cash flow. Second, dividend growth companies that increase payouts annually. Third, selective high-yield positions used carefully and in moderation. Investors today combine income with growth rather than focusing only on yield. This protects purchasing power from inflation and allows income to rise over time. Inflation quietly reduces fixed income streams, which is why dividend growth matters more today than it did 20 years ago. Why dividend growth matters? A company that pays 4% today but increases that dividend by 8% per year becomes significantly more powerful over time than a company paying 7% with no growth. Dividend growth compounds just like capital gains. Over 10 to 15 years, rising payouts can double income without adding new money. This is how long-term dividend investors create freedom without constantly chasing new opportunities. Before building a dividend-focused portfolio, stability must exist. High-interest debt should be eliminated. Emergency savings should be established. Basic investment discipline should already be developed. Dividend investing is a long-term structure for wealth and income. Provide income must come from different sources. Therefore, relying on one sector or one company creates unnecessary risk. The structure should combine stability, dividend growth, and controlled yield. 1. Dividend growth companies, the core. Dividend growth companies form the foundation of a serious income portfolio because they increase payouts consistently over time while maintaining strong balance sheets. Examples include Johnson & Johnson, diversified healthcare, long dividend history, strong cash generation. Procter & Gamble, global household essentials with pricing power. Coca-Cola, durable brand, predictable demand, decades of dividend increases. PepsiCo, diversified snack and beverage exposure with steady payout growth. Microsoft, growing dividends supported by expanding cloud revenue. These companies may not offer the highest yield today, but they provide rising income and capital appreciation over time. That combination protects purchasing power and reduces the need to constantly adjust the portfolio. 2. Dividend ETFs, instant diversification. For investors who prefer simplicity, Dividend-focused ETFs provide broad exposure with automatic diversification. Examples include Vanguard Dividend Appreciation ETF, focuses on companies with consistent dividend growth. Schwab U.S. Dividend Equity ETF, strong quality screen with sustainable yields. iShares Select Dividend ETF, higher yield exposure across multiple sectors. Vanguard High Dividend Yield ETF, broad high-yield companies without extreme risk concentration. ETFs reduce company-specific risk and simplify management. For many investors, combining individual stocks with one or two dividend ETFs creates balance between control and diversification. 3. REITs, real estate income. Real estate investment trusts distribute large portions of rental income to shareholders, often producing higher yields than traditional companies. Examples include Realty Income, known for monthly dividends backed by commercial real estate. Prologis, logistics and warehouse properties tied to global commerce. Digital Realty, data center infrastructure supporting cloud growth. REITs add income but should not dominate the portfolio because they are sensitive to interest rates. 4. Utilities, stable cash flow. Utility companies often provide reliable dividends because demand for electricity and water remains constant. Examples include NextEra Energy, combines renewable growth with regulated utility income. Duke Energy, steady power generation and predictable payouts. Utilities provide stability during economic slowdowns, but typically grow more slowly than technology or healthcare stocks. 5. Telecom and infrastructure. Telecommunication companies generate recurring subscription revenue, which supports dividend payments. Examples include Verizon, strong cash flow with higher yield profile. AT&T, restructuring towards sustainable payout levels. These companies can offer higher yields, but require attention to debt levels and payout ratios. How to structure the dividend portfolio. A practical modern structure could look like this. 40 to 50% dividend growth companies. 20 to 30% dividend ETFs. 10 to 20% REITs. 10 to 15% utilities and telecom. This structure spreads income sources while balancing growth and stability. The focus should remain on payout ratios below 70% for most companies, manageable debt, and consistent earnings growth. Living off dividends works when income grows faster than expenses. Dividend investing has two phases: the accumulation phase, the distribution phase. Most people fail because they confuse them. Phase 1, accumulation. During accumulation, dividends are not income. They are fuel. Every dividend payment is automatically reinvested to buy more shares. That increases your ownership, which increases future dividend payments. For example, a portfolio yielding 4% that grows dividends at 6% annually can double income roughly every 10 to 12 years without new capital. This is why patience matters more than yield. During this phase, reinvest everything. Add capital consistently. Avoid lifestyle upgrades tied to dividend income. The focus is growth of the income stream, not consumption. Phase 2, transition to living off dividends. The transition happens when annual dividend income reliably covers essential expenses. At this stage, dividends stop being reinvested fully. Instead, essential expenses are covered. Excess income can still be reinvested. Capital base remains mostly untouched. The principal is protected. Living off dividends does not mean selling shares regularly. It means allowing companies to pay you from their profits while ownership remains intact. This is the difference between income investing and asset liquidation. What to do during market crashes. Market crashes do not stop dividends from strong companies. Prices fall faster than business fundamentals. Dividend investing will not make you rich in 1 year. It builds wealth quietly while others chase volatility. Income rises gradually. Freedom appears gradually. That is how life off dividends is actually built.